Tom Hayes and Chris Robinson. Tom, what is missing from this picture? There's always something, isn't there? And what are you buying or even selling?
Yeah, well, Liz, as you said, Fed's going to keep short rates low to 2023. They're going to keep in the market at $120 billion of Treasury and mortgage-backed securities per month. Check. Congress is going to do a $900 billion bridge to get us to full vaccination by Q2. You've got global pent-up demand from $20 trillion of fiscal and monetary support around the world. And now you've got a bunch of top callers coming out because sentiment's risen and saying that we must correct because we're seeing pockets of euphoria in the market. I think there will be no Grinch this year. If you want to worry about the Grinch, wait until Q1. Certainly after a 65% rise off the lows in March, we are going to consolidate some gains. That should be used to purchase versus sell. If you remember in 2009, we had a similar gain off the lows. Big corrections in 2010 and 2011. If you sold, you missed out on many years of gains. And also, Bank of America came out with their survey on Tuesday, monthly global fund manager survey. They found yield curve steepening expectations were at their highest level in history. The last 3 times yield curve steepening expectations were this high were November of 2016, August 2013, and late 2008. All 3 times were the perfect times to buy banks because net interest margins increase. They're going to release a lot of reserves, and that's one of our key calls moving forward. Right. Well, Wells Fargo's up 43.6% in the last 7 weeks. We've been talking to your viewers about that for a number of months. And the contrarian trades they put out were actually long energy and short tech. You mentioned the antitrust headwinds. These are echoes of Microsoft 20 years ago. It slowed them down. And long energy.
Let me just jump in here.
Yeah.
I do want to jump in here because maybe, Chris, that's what we are missing, perhaps, and that is, look, the breaking news in the last hour, 38 attorneys general across the United States have now filed suit, and they are blaming Google for monopolizing search. That's really very much not only that, but now it looks like, obviously, Facebook is under attack. Facebook's under attack, and who knows what they're going to charge Amazon and Apple with at some point for kind of dominating each of their areas. So is that sort of be careful here, because that's been the leadership area?
Well, yeah, you always have to worry about that. The time to worry about a correction is when everybody's looking up and nobody's looking down, right? And really over the past 3-4 weeks, I don't know how many people I've heard, experts in the field saying, "Oh, we're definitely going to have 10% next year, 10%." Well, that's great. When everybody's thinking the same thing, though, that gives me pause for worry, and that would be my concern. And everybody also thinks that it's going to be a good thing if they do any sort of antitrust breaking up, because then they're like, "Well, we can't wait to buy all the parts if they break up these big tech companies." So it's amazing to watch the emotion of this market, because the exact same people that were and some of them were in tears back in March and April. Now they're pounding on their chest like Tarzan, saying, "I can't wait for 2021. It's all gravy." So sooner or later, we're going to have a pullback. And I think your first guess was correct. Those are probably dips you want to look for. But it does feel like it's getting kind of frothy. It's at the year end. People are buying things they haven't owned before. You've got, if we get a $50 print in crude oil, how long is it before people start talking about $100 oil again? If we get, and things like that. So you're starting to see that. You're starting to see big moves in commodity prices. Cotton has gone up 45% since the lows. Soybeans, same thing, 45%. Right, tremendous rallies. And what's fueling that also is the weaker dollar. Nobody's talking about that today. We made a new 3.5-year low. If we go another couple pennies lower, we're going to be at 6-year lows in the dollar. That's back to where we were in 2018. So there's a lot of, it's always good when the markets are rallying like this. But I caution everybody is very, very, very bullish right now. So, again, I'd be more worried about some sort of an unseen correction. That's always the thing that we don't expect coming that get us.